Okay, good evening, guys. It's another live webinar now. I'm going to talk about this week has been a big week for events. So lots of things in the news, lots of things fundamentally they're going to be shifting the markets. Once again, we're going to focus on the main FX pairs, the indices, gold. Trying to understand the bigger picture stuff of what's being affected by the news. Obviously, that man Donald Trump. Is he an evil genius? Is he a rogue politician? I mean, it's quite clear to see that if he wants to do something, he's absolutely set out and prepared to go and do things in a very different way than traditional presidents and politicians. And I guess in some ways you have to respect that. I don't particularly rate the guy, but that's not really down to that's not my call, not my decision. At the end of the day, he's going out into the world. He's taking things, relatively on face value, which maybe that's what the world needs. I don't know. It's very difficult. But our job as traders, economists, as technical analysts, etc., we have to interpret what's happening in the world, what's being done, and then take that back into the realms of the technical, of the markets, and try and figure out how we can make some money. At the end of the day. So I've said it once in these presentations. I'll say it a million times. Trading about being right, not about being right at the right time. So it's taking the information you have now, or it's positioning yourself prior to this information, and trying to figure out an outcome before these things happen. So all the things we're going to talk about. We're going to talk about Trump, obviously, his effect on the market. We've got big data out from the UK. We've got some German figures out, the ZEW, and again, but these are not a huge event compared to obviously how Trump's going to be hailed as the next rightful winner of the Peace Prize, and how he's brought the Korean War to an end, etc. What we're really going to focus on, what actually are the details of these things, what has actually changed, what has actually going to change the market sentiment, what's going to push through into the currencies, how's it going to affect the dollar, how's it going to affect gold, how's it going to affect the indices, and again, using that information to position ourselves to potentially kind of do some good trades and make some money. So as always, I'm going to switch over to my charts. This will give you the best idea of how the market is performing, and what really we can kind of take from this information that's being put out into the world, and how we can use that for our trade. So we can see the markets right now. You see the same 8 windows that I always have. That's what I've looked at really forever. And it's not quite as glamorous as some people try to make trading with the 10 screens and their the fancy tickers, etc., etc. I can tell myself, more importantly, pretty much what's going on in the world, and how I want to position myself based upon these correlations. So we can see there's been a bit of a move in the currencies. So what's interesting is the dollar hasn't really moved on the back of this Trump summit, and the market's really consolidating, and that's a traditional kind of pattern. You can call that the wedge, or almost like a pennant style pattern. So it's looking like it's primed to hit to the upside. So we've got levels up here we know the market could get to. But again, that kind of fundamental kind of standpoint is that I guess from the Trump perspective, the world's saying no news is good news. So he hasn't come out and he hasn't cancelled the talks early. He's been quite positive, upbeat. He's complimented Kim Jong-un, and he's been quite for Donald, he's been quite statesmanlike. He's been quite presidential. So, that's early days. What's going to happen from now on, who really knows? But at the end of the day, everyone seems to have gone away from being happy. And it seems that, what the main points of the summit would talk about, North Korea giving away its nuclear arsenal and, denuclearizing, and just trying to bring peace to that region. So, again, really nothing has hit the markets to kind of give it, that emphasis to say, yeah, this is good or bad news. And that's why we see the dollar not really moving. So conversely, what we've seen is a big move up in the euro and the pound. So what you generally see, strength in the pound, strength in the euro, you'd want to see the dollar weakening. So as the dollar's not weakening, and intending for me not to look like it's going to weaken in the short term, because obviously there's the air quote success that Trump's had, and also the fact that the longer term sentiment is that the US are going to continue with rate hikes, and there's going to be more rate hikes this year, another 3 potentially, and we're not going to see 3 rate hikes in the pound or the euro in the UK or eurozone. So what I would see is if this dollar doesn't start moving, that we'll see an overextension in the pound, hit some high levels. So it'd be a good opportunity to start trying to find a position or an area we'd like to get short the pound or the euro, as I'm kind of thinking that the dollar's going to continue to strengthen. There's nothing kind of fundamentally or even technically that really says the the dollar's going to weaken. And we go through the higher time frame. So we start on the monthly chart. A little bit kind of messy there, but we can see that we've been at that correction in the dollar. It's continuing to kind of go up, and the weeklies, although we've made some lower lows, really, the dollar wants to be back at 113, maybe 117 against the yen. It can go into all different reasons behind why I think the dollar is going to remain stronger than the yen. But I mean, they kind of boil down to the same things I've said for years. Japan is struggling to fill its empty employment. It's got an aging population that has no chance now of being able to kind of get back into check. It doesn't really want to integrate foreign workforce. And essentially, when you talk about the Japanese government, they own a substantial part of the Nikkei. Over 50% of some companies in the Nikkei. So there's lots of things that Japan has done to keep the show on the road. But demographically and just kind of really from its fundamental standpoint of how it sets its stall out, it's old-fashioned thinking in a new world. So, like Olympic, Donald Trump's going to go out, for the next couple of years at least in his presidency and do things. And on paper, the American economy is strong. And although a lot of the central banks have been dumping the dollar in favor of the euro, as kind of a safe haven currency or kind of like global currency, they're not going to put it anytime soon in the Japanese yen. So really, for me, as the US, providing can service its debt, keep issuing debt, keep issuing bonds, keep putting interest rates up in that stronger economy, then the demand for the dollar is going to be there. So you can see on the weeklies the kind of reversal pattern holding above the 23.6. The 50%, is a key test above 111. But really, as you get through to the dailies, it's just buying low. So you see the Bollinger Bands, rejection. Bollinger Bands gets the moving average. That's acted as support. So easily, the target's getting above, this 110.80 mark. And, really, again, 111, 113, 114, 117. All these levels, that we've seen in the past, they've acted as support and resistance. I've got to come back into vogue. I mean, the Japan's not going to put its interest rates up anytime soon. And that's one of the main drivers between demand for currency. So even back into the hourly charts, which is a really good kind of indicator, as you can see, that consolidation mode towards the top of the range, it's much more likely, on the short-term trade, we're going to move up to these upper resistance points than we are to drop down, unless, Donald Trump says, actually, I was lying, it was a terrible meeting, and also we're not going to move on interest rates. It's just what we're looking for is always that forward guidance, from the people in power. You can't always take Trump on what he says at face value because, he doesn't control the Fed. No matter what he thinks, he doesn't control the Fed and the interest rate decisions. He's not really in charge of monetary policy. He's the figurehead. He's the person that, says the bigger picture stuff, and is the face of America. He shouldn't be, certainly like he did when he tweeted about the jobs report on the first Friday of the month. That's not his place and it's not his position, and he will get reprimanded for that. It's an abuse of power. He can't be meddling in kind of in these kind of fiscal events. So for me, as I say, the consolidation towards the top of the range, no bad news, no real kind of indication that the economy can't sustain higher rates. And higher rates, again, all these things are being priced in. We're talking about another 3, but it could be another 2, another 1. As long as it's still more than the rest of the developed world, you're still going to see demand for the dollar. Okay, so as I say, this consolidation towards the top would lead me to say that this market's going to break up higher. If that breaks up higher, it's going to put pressure on the euro and the pound. So what we're looking to do, sell it high. So if you're new to my presentations, I talk about a lot of stuff. Trading's pretty fast paced. I'm not talking about investing. I'm not talking about, holding long-term positions. Certainly if you want to do that, we can talk about that. We can talk about, baskets of currencies, playing indices off, anything you like. What I'm talking about here is really making money. So what I want to do is see these green candles, expand, go up to upper levels of resistance. You'll be selling when the market is at its greenest. Yeah, that's the definition of selling high. When the market's at its reddest, you want to be buying low. Okay, so these candles in the FTSE, for instance, hitting points of support. So if you want to buy the FTSE, that's the very definition of buying it low. Yeah, when the market's at its most red point, because it has to turn from red to green to go up. So what you're looking for is those short-term bounces, those short-term scalps, and being able to get into to the markets, all those extremities, and just buying it back to value. So the Bollinger Bands are good for this. The Bollinger Bands show you resistance, support. The midpoint is the kind of turning point. So all my charts on the hourly, they all have Bollinger Bands, they all have Fibonacci lines on, and it's just trying to gauge where the value is. Okay, so if the pound continues up, the euro continues up, then maybe the dollar is going to sell off. If that dollar sells off quick, I'm going to be buying it because I still think the overall view is I want to be buying that dollar low for all the reasons that I've mentioned. Now, there's a reason why the indices are coming off as currency price increase, the euro increases. Well, this is the DAX, the German indices. So as the German indices become more expensive, people dump the DAX. So the higher the euro, these are fairly recent correlations. They didn't used to happen this way. But as again, sterling gets more expensive, people are dumping out the FTSE because it's a sensible play. The DAX is priced in euros, the FTSE is priced in pounds. Something becomes more expensive, the opposite happens. So the same correlations with the dollar. As the dollar gets more expensive and goes up, gold comes down. So gold coming down for two reasons. The first reason is, again, that Trump-Kim summit. Good news, people go risk off. So they dump risky, safe haven type assets like gold, which are used, as a store of wealth when times are uncertain. So as they go down, the stocks go up. So what we should see is a double whammy here. The dollar's towards the high, the stocks are coming off. So that's something's got to give. Okay, so as the stocks are coming off, either gold should be going up because people, going into gold as stocks come up, or the dollar and the gold has to do something. Okay, all these things are correlated in huge basket of goods, in huge cross trades. Everything is is correlated. Every currency has coefficients. So one thing just can't have a move, and the rest of the markets can't catch up. So something's got to give. Okay, so it's either going to be in gold or it's going to be in the dollar. So what your leading indicator now is what's happening in other markets. So your leading indicators is the FTSE and the DAX, is the pound versus the dollar, the euro versus the dollar. So the opportunities, not saying they're gone in these markets, but they have moved. So you're either waiting for them to continue or turn, or try and pick up which is going to be the next market to move. So if all the European markets, correlated and coming down, maybe that filters through to the S&P, the American markets. If that filters through to the S&P, then obviously the S&P is priced in dollars. Maybe then there's a knock-on effect, to the dollar against the yen. So as we've seen the currency and FX markets move in the European hemisphere, then obviously that's going to have some filter through, or just push through some sentiment into the kind of US priced markets, and something else could give. So that's all you're ever doing really, is looking for what markets have moved, trying to figure out some reasons why fundamentally and technically. Again, I mean, this whole idea is your markets move 80% of the time due to these lines, due to technical information. There's just more technical information out there. People looking for value, looking for support, resistance, any kind of, technical analysis that they can kind of, use consistently within the markets to trade. And then the fundamental stuff is new stuff that's happening. As I said, we do have some other news that's coming out of the markets, and all you have to do is go across to your economic calendar. We've already had some, Australian data out, the National Bank business conditions. So they're expected at 18, came in at 15. The business confidence, they expected at 9, came out at 6. So weaker than expected data from Australia, but that's not really kind of a major global event. That's quite localized. So really, all the things from the the kind of Trump summit have kind of come into play, and they're filtered through the market first. But all that information really is known now. So we do have some other kind of red data that's coming out in 20 minutes from the UK. So we have things like average hourly earnings. So that's again a percentage figure expected 2.9. So if that comes in lower or higher than expected, this could be a precursor to why we're seeing a move in sterling. And if we're seeing a move in sterling, and the dollar's doing nothing, maybe again it's another preemptive move that people are jumping into the euro because they've anticipated that the average hourly earnings of the UK are better than expected. Better average hourly earnings, more positivity for the economy, more positivity for the pound. As the pound, as the dollar's doing nothing, people jump short term into the pound, and dump the dollar. That's all we're doing. So people are buying the euro, dumping the dollar. So these are all things you need to look out for. The other thing we have is the German ZEW. So back in the day when I was a trader on the floors, ZEW was a big figure for the DAX. You have to remember, Germany's the powerhouse behind Europe. Germany is a huge producer, massive producer, massive exporter. And it really is the bankroll for the European Union. So we're talking about the problems in Greece. It's Germany's money that's sorting it. So the problems in Spain, Italy. If Germany's doing well and can keep putting money back into the Eurozone, then everybody is able to survive. But if that confidence and that ZEW figure is lower than expected, then that can have a negative effect. So again, all the money generally is to be made on the left-hand side. So when you see big moves like this, the pound's been generally pretty low. It's been hurt by Brexit negotiations, but you could draw a simple, kind of trend line here, so the market was low, lower low, lower low, failed to make a lower low here, towards the bottom of the Bollinger Band, support we found. So you can say, yes, of course, this is people preempting a better figure, or people are just buying the pound low. Remember, if you're buying it when it's reddest, that's when the money's made. So plenty of opportunity for what goes red to go green. And you don't have to buy or sell the absolute low, sell the absolute high, buy the absolute low, or vice versa. As I've told you, in short-term trading, you're just trying to get on the bottom of something. So if you find this trend line, you buy it to the moving average, you bet you have 30 pips. If you hold on a bit braver, 70 pips. That's a good trade. 70 pips in an hour. If you're trading 10, 50, 20, $100 a point, it's all about a $7,000 trade. That's what short-term trading is. Not buying a dollar's worth, of the pound here and waiting, for eternity to go back to 148 or whatever. Whole point is picking out where markets are going to turn. So as you go down the time frame to the 15 minutes, again, you can see these, these charts become more kind of forgiving. You see the Bollinger Bands again, as they get tight, they have to expand. As they expand, they have to contract. And as we see the market reject and consolidate towards the bottom of this trend line, the market is said, when we reject these low points, we go higher. Yeah, reject these low points, we go higher. Reject these low points, okay, not so high that time, but it's still a winning trade. Reject the low points, higher. So you're just waiting for your green candles to close and you remain high until there's a turning point, or until these Bollinger Bands are too far apart that we have to get some profit taking, the market comes down. So maybe that happens in 20 minutes when the data comes out. Maybe it doesn't. Maybe it kind of it carries on with the data, pulls up and then comes back down. Trading's all about being right at the right time, knowing why things are moving, preempting why things are moving, and just being on the right side. So as I say, if it's the euro and the pound that are moving, in a particular direction, and something else hasn't, then maybe that's your opportunity. So again, look for that UK data, and that UK data comes out in what we know, 17 minutes. If that comes out worse than expected, people are going to dump the pound. That's going to go down. The people are going to buy the dollar. So you can sell this and buy the dollar if you want to kind of average yourself up, or maybe you think that negativity for the pound could be positivity for the euro. So you sell the pound, buy the dollar, or maybe hedge some with buying the euro dollar. Because if you think the European Union is going to win out, if the UK is having a bad time, again, it's all putting different plays into the market. So it's all giving yourself an idea of what can happen, kind of where, why, and when. So other kind of markets have been focused on, kind of this side of the world. We've got the New Zealand dollar versus the US dollar, and also the pound versus the New Zealand dollar. So these are just daily charts. And these are just kind of key levels that I've been looking for. So the 50%, it's been working well. Has the 61.8 in the New Zealand versus the US dollar. So, the New Zealand dollar seems to be a stable economy, stable, safe place in the world. So when times are uncertain, again with Trump and these kind of summits, then maybe people go into New Zealand dollar as a bit of a safe haven. So we've happily sold off from the 50%, happily sold off from the 61.8. The market couldn't make a new low here below this, so we've actually crept back up. So at the decision point, if that dollar is going to get stronger, as I think it is, then that really should mean that the New Zealand dollar finds resistance on the 61.8, starts to move lower in the trend, and get below the 69 level. Remember, other points for New Zealand is that it's a big exporter. It relies on tourism, so it doesn't want a particularly strong currency. It wants people to have a good time and spend their money on goods and services. So again, that's another reason why New Zealand dollar could come down as the dollar strengthens. As that correlation happens, there's been quite a good correlation with pound versus New Zealand dollar. So obviously, as that's come back up, the pound's gone back down. Pound is obviously affected by Brexit negotiations, by the shops that are closing, in the UK, etc., etc., etc. Shops closing all over the world. It's nothing new. The UK is not immune to anything. But it's figuring out what the world is betting on, what the world is doing. So as I said, we haven't made a significant close below this 38.2. So we've still got a value area between the 50% and 38.2. So my thinking really is as we get closer to Brexit negotiations kind of working out, we have seen, on the higher time frames, significant sell-off of the pound versus New Zealand dollar. I mean, we're up above 2.5 kind of previously. I mean, had a big sell-off. Brexit is the main driver behind that. But as we get closer to Brexit negotiations happening, I can only see the pound strengthening. And as we have ideas of what Brexit's going to look like and trade negotiations and, all the other things that goes with that, then you have to see some of that downward pressure alleviated. So obviously we've bounced, we've got as low as 168, but the market has recovered and been just shy of 2. So really, for me, I think, for my my thoughts analysis, we want to be breaking above, 199, and I think, we're going to be happy, above 2 in the pound versus New Zealand dollar. Again, my view is that the markets are consolidating here. Lots of attempts to break lower, but we're actually kind of consolidating towards the high. So for me, we've kind of set up our weekly view. The market's consolidating, had a bit of a fake out here. The market's finding good support. So as we consolidate again towards the lows, I think we could then move towards the highs. It might be some time before, the pound strengthens. But again, every week, every month that we move forward towards that inevitability of Brexit, as long as it isn't a hard Brexit, Brexit is essentially going to happen and it has to be fixed, okay, in one way or another. So I only think, really, for me, that's positive. So I think really the weekly, we're still on an uptrend. As you get towards the dailies, as I say, I think we're consolidating towards the low. We have every opportunity to hold above the 50%, get some strength above, above 191, 192. And then as, again, we get through to the levels we've found that would support resistance. I really do think 2 is an overall target. So again, that's a longer term view. But if you look on the kind of hourly charts, what have you seen? Well, as the pound's moving against the dollar, it's moving against the New Zealand dollar. And what could we see again? The same kind of formation. Lower lows made, market hitting support, and you're buying low. So if you just bought the low of the pound of the rejections on these green lines, there we go. You're making 86 ticks. Today, 92 ticks. So you're making money, in the short term. That's a 2-hour trade. Even if you look at the 15-minute. Again, you're just buying on the low levels, where the market's found previous support resistance. And even if you catch the tail end of it, just the 50%, and you just buy it, for the final kind of half an hour trade, you're still making 26 pips. As I said, on $50, $100, $200 a point, which is not really big money these days. Remember, this side of the world, why I came here, in the UK, with the new rulings, MiFID II, ESMA, you can only get, as a retail trader, 30-to-1 leverage. You guys can still get 500-to-1 leverage, 500 times your money in the markets. So if you have, a decent sized account, you can leverage up your money and you're buying, and you're making money all the way up the curve. This is how trading's done. So again, these are really good kind of patterns, these kind of rejections. We see the market, sold off, come back strongly. The market's consolidating, but lots and lots of traders been buying back up. Rejecting a close lower. So people are loading back up at these low points, consolidating. It looks like that's going to move higher. It looks like rejection, consolidating towards the top. This can then move lower. And once we get to these lower pressure points where the stops are, then you can easily see the market move down, to these lower levels. Okay, so it's always cycling through your charts, trying to find out, where the value is, daily, hourly. Then the other things, big news, good old Bitcoin. Well, what happened to Bitcoin? That's what happened to Bitcoin. Don't like to see these things, do we? Big gaps. So Bitcoin's done 10% of its value in a couple of days. At the end of the day, there's lots of things. I'm not here to say you should trade Bitcoin or not. I've studied the markets, traded the markets for 15 years. At the end of the day, I believe in core principles like the Dow theory. So Dow theory is we know why everything is trading at a certain price, because all relevant information is known. We don't know who the inventor of Bitcoin is. Don't know if it's a person, company, man, woman. So if you don't know that much, how can you possibly know how you trade it? People like the idea of Bitcoin because it moves. Well, I'll tell you what, if you're long Bitcoin and this happens, you don't like Bitcoin anymore, because that is a serious move. Okay, at the end of the day, that's moved, 10,000 pips. You're not going to be able to hold a stop below that, and that's why movement is good in markets, but this kind of movement, for a short-term trader, there's nothing you can do. You can't chart it. You can't have a reasonable risk reward ratio with it. So when you cycle through to things like gold, gold that's used all over the world, gold that's in hedge funds, gold that's part of central banks, gold that's part of billionaires' portfolios. It can't just drop that distance, because people will buy the difference. So even though you've got volatile markets, like this. You can still see where the market buys up, it rejects and comes back down. So you've got opportunities to get into trades, but also get out of trades. Trade when you're right, get out when you're wrong. Yeah, rejections. You can buy it low and still get out, when it's high. It's not just moving, too aggressively one direction, giving you no idea of what it's going to do next. So really, if you're not trading individual shares and you're not kind of trading, kind of from that kind of perspective of building up a portfolio, all these things that I keep saying, like, the major FX markets, the major indices, gold, these are all good things to trade because there's real volume, real liquidity. Markets will move up and they'll move down, but they'll always correct because somebody's got to be wrong in the short term and somebody's got to, take that money. This is the thing that people don't really kind of understand when you talk about intraday trading. They're thinking, you still got to buy the low, sell the high, all that kind of stuff. You don't really have to do anything apart from find some value. And, that value can be this FTSE selling off from these highs and hitting this low and bouncing up 10 pips. You can wait for this market to sell off and bounce up 10 pips, and that could be your trade for the day. Doesn't matter, if you still think the FTSE is going to go down or think it's going to go up above 8,000. You're not holding it for days, weeks, or months. You're not holding it for significant periods of time. What you're doing is using this intraday movement, using this movement of the candlesticks when the markets are open to figure out technical patterns, to understand this news that we've heard, to understand the UK data, the German data, Trump's summits, Trump's tweets even, and then use them for the short term to try and make those short-term gains. This is really what when you see the people on the phones and you see the kind of pits, this is what people are doing. They're trading this information. Yeah, they're buying value for very short periods of time. Yeah, or selling value for very short periods of time. So as I say, the dollar's starting to catch up now. As the euro and pound are at their highs, dollar seems to be coming off. So if you see that bad data, the pound comes down and the dollar's anywhere down here, you'd load up. You buy as much dollar as you can down here at these lower levels, expecting the dollar to go up. With the overall trend and with the fact that the pound might come off and people are dumping pounds, buying back into those dollars. Yeah. So as I say, you see the indices coming off now. So remember, there wasn't any movement in the S&P, but as the FTSE continues to go down, as the DAX continues to go down, we've got targets where they're going to get to, but America's had to get it back in the game. Traders are selling the S&P based upon what's happening in Europe. So we're kind of trading here before we started talking. So we've gone down 29 pips. Again, 29 pips, it's not the most amazing trade in the world. But if you're trading the right kind of size and you're trading with the right kind of momentum, 29 pips is huge. Yeah, I'm only ever looking for 20 pips. Yeah, 25, maybe 30 pips on a good day. But I'm trading 500, 1,000, 2,000, pounds a point. I average in, I'm aggressive. I get in, I get out as quick as I can. And my trades are a minute, 5 minutes, 50 minutes, maybe an hour. But they're never more than a day. Never. I never hold overnight positions because I'm just trading when the markets are open, using the movement, using the information, using the liquidity. And, this is just what professional traders do. This is what retail traders can do. You're just trading the movement. You're trading based upon what the market is giving you while it is open. Okay, so we've got 5 minutes or so before this data comes out. So has anybody got any questions? I mean, again, these are meant to be, pretty open, formats, open forums, I'm kind of, at a crossroads. I moved to New Zealand without ever coming to New Zealand. I'd never been here before, but I have the freedom where I can trade. I can kind of move and do whatever I like. So I'm kind of in New Zealand and I'm trying to tap into this side of the world and see what you guys want to learn, listen to. I have hundreds of clients in the UK. I've taught thousands of people to trade. I've started people from their own hedge funds, and I could do that for people this side of the world. But you've got to speak to me. What I'm not doing is going to keep spending, $70, a CPC on Facebook or Google, trying to get people into these rooms. I just don't need it. I don't need the hassle. I'll just carry on doing what I do. But, if you want to hear stuff, you want to understand the data, you want to interpret the markets, ask me the questions. Again, it's all about, I'll keep, doing these as long as people are interested. But if people aren't interested, I ain't a charity. I've got better things to do with my time. So come on, guys, questions. What do you think? What do you think of the Trump summit? Are you bullish the dollar? Bearish? What are you going to think of gold? If that dollar's going to keep going up, the interest rates are going to keep going up, gold's going to get hammered. What are your thoughts? What do you trade? Why are you sat here? Go to the chat window. Just ask me anything. Type in any question you want. Just tell me what you want to know. the end of the day, these things are, they can help other people. I've always had open forums. I don't do recordings that people can listen to time and time again. Everything's the here and now. Just like with trading, you don't get any second chances. You don't get any, take backs or gimmies. It's not like, you can say, oh, if I wasn't actually ready for that trade, can I just have my money back? The market doesn't allow you to do that. So what we're always trying to figure out is what's going to happen in the next, tick, the next minute. What's this claimant count going to be? What's this, average hourly earnings going to come out as? 2.9 is expected. How's the market primed? Well, the market's primed here. It says that it thinks it's better than 2.9. So it's better than 2.9. Okay, maybe it's only 3. Maybe it comes down. Maybe it's 2.9, it comes down. Maybe it's 2.8, it definitely comes down. Or maybe it's, in line at 2.9. Then what happens? It's exactly as the market thinks. So it's not just, necessarily that, we're going to get the confirmation. Maybe the market, is expecting it to be a bad figure, and it's going to be 2.7, 2.6. So in the preamble to this, the market's been pushed up, a short squeeze, market comes out with worse than expected figure, bang, breaks this line, downtrend continues. These are all the things you have to be thinking about at all times. What is the market making you think? What is it dragging you in to do? We can all look at a chart on the long term and think, pound's going down. Okay, but you have to be right at the right time. So if you start selling the pound, here, and it goes up to here, then here, you're out. You're stopped out because that's your risk reward. All of a sudden, the data comes out, the pound's down here. You're like, oh, I knew it. I wanted to sell a pound. But you've got to sell it high. Yeah, you got to wait for the turn. So it's all about being quick, preempting the data. It figures out 2.8, so it is actually worse than expected. Okay, so the claimant count is 7.7, expected 11.3. The unemployment rate is 4.2, 4.2. So it's actually slightly lower than expected. So, this could be a great way of just understanding where the market can go from this point. So we say the market was this low point, got to this high. Excuse me, 50% of that move is here. So this is your pivot. So this line here now is your pivot based on what we know. So the market was expecting 2.9. It came out at 2.8, so slightly lower than expected. So it's either going to do one or two things. It's going to carry on with this movement and think that 2.8, not that bad. It's only, 1 percentage point out of, what was expected. It goes on to make a new high. Or if it cannot make a new high, it's going to come back to that 50%. Yeah, which is, the down move to the up move, and that's going to be the pivot. So the pivot is 1.33798. So if you think that's going to be, worse than expected, it's not, good enough figure to keep the, sterling going up, then it's going to get to that 50%, and that's where it's going to turn. But as we can see, that's the 50% that we've drawn is actually acting as a nice bit of support. So again, this has to make a new high if it's going to continue this up run. So the new high is where we drew it. So it goes from the new high, it gets to here, resistance point here, and maybe here. So that again, if you don't think that 2.8 figure, is good enough, then let the market make new highs, but try and figure out where it's going to be its greenest. So it's going to be its greenest here, or maybe the resistance point here. Yeah, that's when you get short, and then as the market opens up red, you've got points of attraction the previous fibs where you can get back to. So I mean, all these things, you got to kind of look at them in real time and think, where's the value? Kind of. That dollar's coming back up. That dollar keeps going up. Then maybe sterling's just going to continue to push higher to squeeze people out on what isn't a great figure, and then the market's going to come back down. But again, this is the whole point. Sterling can push up for the next 15 minutes to get all the people that are selling sterling out, and then it comes down. You've got to be right at the right time. Yeah, William's saying you've drawn trend line support on GBP USD. Maybe the upper trend line could be resistance. Yeah, I mean, exactly. The whole point is all these things, that we have on our charts are designed to be support and resistance. It's down to us to interpret what we can chart and what we can kind of replicate. The whole point of my charts is that, they're all algorithms. So they're all running all the time, and keeping updated with the market moving. So I don't have to draw in these lines. They're already there for me. So I know exactly when I look at a chart what it's trying to achieve. Can you run us through the technical analysis, a pair, how you interpret the indicators, please? Yeah, I mean, this is the whole point. So what are you looking for? Take gold, for instance. Is the market, when it gets these red lines, these are expansion points, Fibonacci. So as the market goes up, it's going to find exhaustion, and it's going to then come back down to a point of the 50% retracement. So 50% retracement is always where I'm looking at. That's where I tell value. So we got above value, we got above the Fibonacci expansion points, we came back down, but this is acts as perfect support and resistance twice in gold. So as it comes down, it's going to get down to the retracement points down here. So the longer term for me in gold, yeah, If it holds below that 50%, the longer it does, the more likely it is to go to these lower levels. So I'm selling gold, yeah, and I think the dollar's going to go up, gold's going to get more expensive, get down to here, market then consolidates and gets down to here. So, you've got expansion points, pivot point, retracement points. So as you can see, as the market hits these, holds below the 50, yep, hits these, holds below the 50, hits these, goes below the 50, yep, below the 50, below the 50, hits these, below the 50. So you're looking for that always, yeah, where the value is. So that 50% type trade comes through to all the different markets. So again, the FTSE, for instance, 50, market comes down. Yeah, hits these, points. 50 comes down, hits these points. Yeah, so you can buy it from the low and get back to the 50, or you can sell it from the high, get towards the 50. It's all understanding what your overall view is and how the market's trying to be interpreted. I mean, again, if you want to go to it in more kind of detail, take the FTSE, for instance. You're breaking it into time frame. Okay, so you've got your daily, your hourly, your 15-minute, your 5-minute. So your 5 minutes been great. The market consolidates on those 50, that 50% point, can't break these points. Now it says here, yeah, we're looking to sell. Yeah, the market's at a good sell point. Yeah, so it's all the way down. So the market now has got towards a buy point. So you could say the market's getting to exhaustion. Yeah, so there could be now an opportunity to buy the FTSE low. Yeah, but then you've seen, again, seeing it on the 15 minutes now to a buy. So maybe, you start to look at these points for bounces. And again, looking towards a buy on the hourly. So these points, the bounces. But you'll be buying it when it's red. Yeah, you don't want to be buying it when it's green. You want to be buying it when it's at its most red point, buying low, waiting for it to turn. Okay, so yeah, obviously the shorter the time frame, the more action you see. But again, it's all part of the same thing. You see, the 50% hits these points, and it should really, in a short-term trade, have some bounce off that 423.6 because that's the final retracement. But that acts as resistance instead of support to get back to the 50%. So that's a really bearish figure, a really bearish indicator. So market then comes down, but as we see, this could be your bounce point. Yeah, bounce point on your hour. And so you've got to look through the different time frames for the right kind of thing because all these lines, the Fibonacci green and red, mean different things on different time frames. The dotted lines, the blue and white lines, they're the same on everything. Yeah, but on the hourly, 50-minute and 5-minute, they're all down to the movement of those time frames. So again, it's looking through and going, okay, so no way out of value on the 5 minutes. Where's the 15-minute value? Okay, maybe down here. Where's the kind of hourly value? Or maybe down here, what was resistance? Now becomes support. So it's using the technical analysis for what it's there for. Lines are lines, points of attraction are points of attraction, support is support, resistance, resistance. At the end of the day, as long as you've got your chart set up with those lines, what's happened in the past could be something that could happen in the future. So again, it's always looking through your charts, and it's difficult because there's no exact science. There's no, kind of one way to do technical analysis. There's no holy grail of it. All you've got to do is do something that's consistent. And I found consistency in, points of attraction, straight line support and resistance, Bollinger Bands, and Fibonacci. That's pretty much all my charts are. And that's all I've done for 15 years. Find out any chart that I can interpret with those 3 indicators and make money. Well, I mean, the GBP can pull back before the data, for many reasons. I mean, again, the money's to be made, isn't it, on the left-hand side? So people could be heavily long. And as the market, is coming up, they're selling to get out of their positions. They're selling to get out of profit. I mean, this is the whole point, isn't it? Markets are moving, based upon what has happened. So the data has come out. It isn't, exactly in line, but it's certainly not bad data. We're not talking about, kind of huge miss in that. So obviously people are, thinking that there is some value to be had in the pound because it's relatively low, and data that's not bad data isn't good data. But again, it's that sentiment. We've had quite a bit of bad data out of the UK. So markets are particularly low. So the data isn't as bad as expected. That sentiment comes back in and goes, right, well, it isn't as bad as expected. So let's buy what's not terrible. This is what happened in the US for years and years and years. The data wasn't great, but it wasn't terrible. So as long as the data wasn't terrible, they were going to carry on with quantitative easing, kind of tailbacks. They were going to, do things to stabilize the market. It's going to move on interest rates. So it was almost as long as it wasn't bad news, everything was good news. And that's why the markets have gone up. That's why we've made, new highs in the, the indices and record highs in the stock markets. Because the 1%, top 10%, whatever, are still long. So as long as you're not hearing terrible news, things are carried on. So I mean, these things are interesting, aren't they? I mean, again, it's all down to interpretation. It's all down to looking at the markets. I mean, maybe there's just a different way that you guys look at stuff. You know, maybe you're more interested in individual shares. Maybe you're interested in, you know, kind of picking longer term investments. You know, I don't know. I'm just telling you what I've taught people for you know, for 6-7 years now. You know, how to read correlations, how to technical and you know do technical analysis, how to buy low, sell high, how to you know read these coefficients. You know, how to just look at 8 charts and go, where's the value? These stay high. Your values again selling the dollar in the short term, buying it back from the low point because you know eurozone and you know UK are still weaker from an interest rate perspective than the US. So again, it's using these you know bits of information, using these technicals to get involved in the market. I mean, anything else, guys? Any other thoughts or questions? I mean, you know, again, it's all down to the time frame. These are hourlies, you know, so feel free to cycle through to your 15-minute charts. You know, everything, you know, is an opportunity. As I say, that 50%, you know, again, as long as you see the 50 minutes that we've drawn from this low to the high, that's a pivot. Okay, so fail to make another new high here. So if the market can't go to, you know, make a new high, it's going to get back to that 50%. Then it breaks that. It's got every opportunity, yep, to retrace that entire move and move lower. So again, you can cycle through the different time frames, cycle through, you know, anything that kind of makes sense to you. It, you know, it doesn't matter, you know, what I think or I view the markets. It's how you use the data, how you use the technical analysis for you to use the market. You know, people are always looking. This is why I do the courses. Well, not courses, webinars, the way I do them, because everyone's different. So if I keep doing them live and I keep doing, you know, different styles of analysis, different styles of interpretation, sometimes it's a light bulb moment. You know, if you want to read my book, then you can read all the things, you know, that I've used in the past. And, you know, it's in depth. You can do it at your time. These are meant to get people drawn in, get people interested. As I say, I'm not teaching people to trade like me because what's the point? You know, what's the point of you trading like me? You know, if you don't have the account size or the experience, what I'm trying to do is, you know, get you comfortable in the way you want to trade, because that's essentially how you're going to be a good trader, by being able to, you know, trade in a way that you find consistent, that you kind of find, you know, empowering. And that's all trading is. All right, guys. Well, I mean, that's, you know, that's it. We've got the ZEW figure coming out later, you know, in 22 minutes. So just look at that on the turn of the hour. You know, check what the ZEW is going to be. Expected 85. So if the DAX is still low and it comes out at 90, buy some DAX low. Yeah, if it's stronger than expected, or if it comes out, you know, weaker than expected, and you know we're relatively high in this selling, you know, momentum. Maybe the momentum selling is going to continue and continue to sell in. So that, you know, that's your first test. Yeah, check what the ZEW is going to be in 21 minutes. Find it on an economic calendar. Go to FX Street. Go to Bloomberg. You know, you can find these things easily, and then, you know, see what the market's doing in reaction to that figure. Simple. All right, guys. Well, listen, anything else you want to do, you know, get me on my email, steve@steveruffley.com. I mean, what I'm offering here is mentoring. So if you want to kind of, you know, trade with me and get these things one-to-one, and me explain, you know, how you trade, how you interact, that's what I do. I'm very, very good at that. Probably one of the best there is. If you want to open your own fund, you know, you want to trade your money, your family's money, or you want to kind of make different income streams from trading, I can make that happen. These are the things that I do for people in the UK all the time. If you want just a better deal for your broker, you want to go and trade with a trusted broker, like the guys, you know, I was out with the rugby, we had a box, you know, watching the All Blacks. That's what I do. I go out. I know all the people, you know, I know the kind of guys I want to work with. I know the guys that give you the best deal. I'm just here to help. And as I say, spend a fair bit of cash now trying to, you know, recreate my reputation in New Zealand, Australia, etc., like I did in London. You know, I'll continue doing it for the next few months, but again, if people aren't picking up, people don't get it, people don't want it, listen, I'm not going to flog a dead horse. You know, got better things to do in my time. So as I say, you know, if you do want to get involved, you know, it's a time sensitive, you know, kind of invitation. I don't charge for my services because I don't believe I need to. If you make money and become a good trader, I make money down the line. And then, you know, nobody's got any complaint points. If you invest money and time in your trading, I'll help you out. And that's just the way I do things. And that's the way it's always worked for me in the UK. Plenty of pages of me on Google. Google away, find out whatever you need. And if you want to speak to me, get me on Skype at Steve Ruffley. Or again, just drop me an email. There's a million ways to contact me. I'm not a difficult man to find. I can help you out. All right, well, hopefully, again, you know, saw something a bit enlightening. Check out that ZEW data in 19 minutes. See how the DAX and the euro dollar react. Remember, if this continues to go down, this euro dollar continues to go up, euro dollar reverses, then maybe, you know, on a good figure, you know, we see this bounce, the DAX bounce, and obviously then that'll mean the euro may potentially come down from these highs. So again, see how the data works. All right, guys, listen, anything else you want to get hold of me, and I hope you enjoyed it. All right, take it easy. Thank you.